Hey everyone, welcome back to Corporate Decoder, the place where we decode what companies are really up to. And let's just say Savers Value Village is doing something pretty interesting with their debt, or rather a whole lot of new debt. Today we are diving into their latest filing, an 8K report. This report tells us about some major changes happening behind the scenes, specifically how this company is borrowing a huge amount of money. So, what is the big news? Well, on the 18th of September 2025, the company through its subsidiaries Evergreen Axio 1 LP and Value Village Canada Inc. They signed a new credit agreement. This is basically a massive loan deal. This new deal combines two main parts. First, a term loan facility of $750 million. Think of this as a big chunk of money to be paid back over a longer period. Second, a revolving credit facility of $180 million. This is like a credit card for the company, allowing them to borrow and repay as needed, up to that limit. Why are they taking on all this new debt? Well, the report clearly states that the money from this new term loan was specifically used to pay off their old loans. They are essentially refinancing, replacing their old debt with this new larger package. This often happens when companies think they can get better terms, like lower interest rates, or when they need more flexibility. Let's look at the details of this new debt. The term loan is set to mature in September of 2032. That is a pretty long time, about 7 years. The interest rate is a bit complicated. It is a variable rate. This means the interest they pay can go up or down depending on market conditions. Right now, it is the reference rate plus a margin of 2.00% or 3.00% depending on the type of loan. There is a cool little detail here. The interest rate could go down if Savers Value Village gets a good credit rating from SIP and Moody's. If they get a rating of BB- or better from SIP or better from Moody's, their interest rate could drop by 0.25%. This incentivizes them to manage their finances well and maintain a strong financial reputation. Now, about paying it back, they have to make prepayments on this term loan if they have a lot of extra cash left over after their regular business operations, but only if their borrowing level gets too high. Specifically, if their first lien net leverage ratio, which is basically how much they owe compared to their most secured assets, goes above 4:1. They also have to use a portion of the money they get from selling off some of their assets to pay down this loan if that leverage ratio is too high. They can also choose to pay it back early themselves, but there will be a 1% fee if they do it within the first 6 months. On the other side, we have the revolving credit facility. This one matures in September 2030, which is 5 years from now. The total amount available is $180 million. Out of this, $75 million can be used for letters of credit, which are like guarantees for other parties, and $25 million is a swing line sublimit, meaning a smaller, quick loan facility. The interesting part with the revolving credit is that they can borrow in either US or Canadian dollars. The interest rate here is also variable, tied to the reference rate plus a margin that can range from 1.50% to 3.00%. This margin depends on how much they owe compared to their most secured assets, the first lien net leverage ratio. Basically, the less they owe relative to those assets, the lower their interest rate on this revolving credit can be. This new debt agreement also comes with an incremental facility. This is like a pre-approved option to borrow even more money in the future. They can add another $13.3 million or an amount based on their earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. This extra borrowing power is also tied to their leverage ratios, ensuring they do not get too deep into debt. Now, for the restrictions, like any major loan agreement, this one comes with rules called covenants. Savers Value Village and its subsidiaries cannot just do whatever they want. They are restricted from taking on more debt, pledging their assets without permission, making certain investments, paying out dividends to shareholders, dealing with their own affiliated companies in specific ways, or selling off assets without following certain procedures. These restrictions are all pretty standard for this kind of financing. There is a specific financial test they have to pass, called a financial maintenance covenant related to the revolving credit. Starting in the first quarter of fiscal year 2026, they must keep their net first lien leverage ratio below a certain level, measured every 3 months. This rule only kicks in if they are using more than 40% of the revolving credit line. They also have what are called equity cure rights, which means if they are in danger of failing this test, they might be able to fix it by bringing in more equity, essentially more ownership investment into the company. Following this major refinancing, it is no surprise that the old agreements are out. On the same closing date, the 18th of September 2025, they officially terminated their existing credit agreement and paid off all the money they owed under it. Importantly, they did not have to pay any penalties for ending that agreement early. They also dealt with their existing notes notes, all $401 million of these notes were redeemed. This means they paid back the holders of these notes. They paid 104.875% of the principal amount, plus any interest that had accumulated up to the 18th of September. So what does this all mean for Savers Value Village? They've basically taken on a significant amount of new debt, totaling well over $900 million when you combine the term loan and the revolving credit facility. They used this to pay off older debts, which could mean they are betting on better interest rates or needing more financial flexibility for future plans. This shift in their debt structure is a pretty big deal. It shows a strategic move to manage their finances. By consolidating and potentially lowering their interest costs and securing access to more funds through the revolving credit, they are positioning themselves for what is next. The key will be how they manage this new debt load and whether they can meet the covenants, especially that leverage ratio requirement. Looking at this, Savers Value Village is making a bold move to revamp its financial footing. By securing substantial new credit facilities, they appear to be aiming for greater financial flexibility and potentially lower borrowing costs. This is a common strategy for companies looking to optimize their capital structure. The success of this strategy will hinge on their ability to manage the increased debt, maintain healthy leverage ratios, and leverage the new credit lines effectively to drive business growth. Given these numbers, the company is clearly in a phase of strategic financial maneuvering. It suggests a confidence in their future earnings to handle this increased borrowing. However, anytime a company takes on this much debt, it's a risk. If their earnings falter or if interest rates climb significantly, they could face challenges in meeting their obligations. The real test will be in how they deploy this capital and whether it translates into tangible business improvements and profitability. What is your take on this massive debt restructuring by Savers Value Village? Does this signal strength or a potential risk? Let us know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button and subscribe to Corporate Decoder for more in-depth looks at company filings. And don't forget to join our Discord community, linked in the description below, for more discussions on corporate finance and strategy. Thanks for watching, and we will see you in the next one.